Today, we're gonna give you tips for beginner investors. What's up, everybody, and welcome to Master Money. My name is Andrew. I'm the host of the Personal Finance Podcast and founder of Master Money. And today I'm gonna give you some tips if you're a beginner investor. Because being a beginner, if you understand these tips and you do these things right off the bat, you're gonna be a successful investor for the long run. And the first one is to cut your losses. When I started out as a brand new investor as a teenager, the first thing I did was I went out and bought cheap stocks, and people call these penny stocks. And what happened was I would go on the internet and find the best penny stocks, and then in one day, all my penny stocks tanked and I lost all my money. So the key to this lesson here is make sure that you cut your losses, because cutting your losses early on ensures that you're not holding on to losses for a long period of time, and investments in particular that make zero sense. The second tip is to start with index funds. Now, index funds are one of the most easy ways to invest in something. In fact, when you're buying an index fund, you can either buy something like the S&P 500 index fund, which you're buying 500 of the best companies in the US, or you can even buy something like a total stock market index fund, where you're buying small cap companies, large cap companies, mid cap companies, and you're also buying all the companies in the S&P 500. So this is a way to look at buying a well-diversified portfolio and starting with index funds. Index funds are great for the lazy investor. If you don't want to be checking your portfolio, or you really don't care about investments, but you understand the power of investing, then index funds are fantastic for you. In fact, the greatest investor of all time, when he hands his money down to his children and his wife, he's putting that money in an S&P 500 index fund. And if you don't know who the greatest investor of all time is, his name is Warren Buffett. And Warren Buffett is one of the best investors to study if you were a new investor. The third tip is to set your financial goals. Having your goals in place and understanding how much you need to save to retire, how much you want to save in your emergency fund, and setting up these goals so that you can start hitting these goals each and every year is extremely important, because relying on your willpower or relying on your knowledge to make sure that you're hitting your goals is just not going to cut it. You want to make sure that you have your goals in writing, you're reviewing your financial goals every single day so that you are automatically transferring the amount of money that you want to invest and doing these things in the right order to ensure your success. The next one is to invest for the long term. Time is your greatest asset when it comes to investing. In fact, if you look at your portfolio over a long period of time, you can take small amounts of money and turn them into very large amounts of money. To prove this, if you look at studies have shown that people who are in their early 20s who just start investing, each dollar that they invest, if they get a 10% rate of return, is worth $88. That means every $5 that you spend is $400. Now that is crazy. So making sure that you understand that you need to do this for a long period of time and investing for the long run is how you ensure success, because the market ebbs and flows. It goes up and down. And to prove this, take your phone out, look at a stock market chart for the longest period of time that you can. And which direction does that chart go? It only goes in one direction, and that's up. But from day to day, week to week, month to month, the market ebbs and flows. It goes up and down. But understanding if you're in this game for the long run, like me, I'm in this game forever. And if you're doing this thing forever, then you understand your money's only gonna go in one direction. It's gonna go up. But if you panic sell because you're a short-term investor, then that is something where you're going to lose money over time. The next one, diversify your investments. Diversification is one of the biggest principles when it comes to investing, and making sure you're diversified as a new investor when you're still trying to understand how investments work is extremely important. This is why I talk about index funds and ETFs all the time, because it's an automatic way for you to be well diversified right off the bat. But diversification just allows you to cast a wide net. Think about it. If you take a jar of marbles, you can either pick out one marble and hope it makes you money, or you can just buy the whole jar. Buying the whole jar allows you a well-diversified portfolio so that you can buy a basket of companies and not have to worry about the performance of one individual company. The next one is to double down on your winners. A great example of this is real estate investing. If you're a fantastic real estate investor, you're great at finding deals, you're great at searching for properties that are going to make significant income, then you should double down as a real estate investor. The same goes for someone who is a really good dividend investor or a stock investor or a value stock investor. Any of these investment sectors, if you're really good at it, you should double down on your winners. The next one, invest in what you understand. So Charlie Munger and Warren Buffett, the two greatest investors of all time, this is one of their big keys when they look at investments. No matter how good the investment has performed in the past, or no matter how well the investment has done, they will throw out an investment if they don't understand it. Now, this caused them to miss things like the tech boom and things like that, but their returns were well above market returns, even without investing in those companies early on. So making sure you understand investments allows you to know why a company is going up and down, why an investment is doing well or doing poorly, so that you have the intricate details as to why that is happening. Because if you don't understand an investment, you won't know when to sell a company when it's doing bad, and you won't know when to buy a company when you need to be buying more, maybe in a recession when it's just taking a dip and it's going to go back up. You won't understand those things. So making sure you understand what you're investing in so that you know exactly when to buy and to sell is extremely important. The next one, and this is a massive one, is to check fees and expense ratios. We talk about this all the time on this channel. Fees will absolutely destroy you. So understanding how to control your fees is extremely important. This is why we talk about index funds as well, because index funds are low-cost investments, whereas an actively managed mutual fund, where it has a fund manager and a team who's buying and selling stocks, actively managed mutual funds have much higher fees, between 1% to 2%. So making sure you're investing in things that are low cost, making sure your brokerage has free trades and doesn't charge you a monthly fee is extremely important, because fees will kill you in the long run. Someone who just pays a 1% fee to something like a financial advisor or a mutual fund will pay well over $100,000 over the course of their investing career just with a small portfolio. So this is a 6 to 7 figure decision to make sure that you ensure that your fees are low. And the last tip I'll give to new investors is to make sure that you remove your emotions when investing. Emotions will absolutely kill you when it comes to investing. So making sure that you take them out of your investing criteria is something that's extremely important. If you're the type of person who panics when they see their investments go down instead of getting excited because it's an opportunity to buy more at a discounted price, then you need to be looking at something like a passive investment plan. Whereas someone who knows and understands that when a company goes down and it's a strong, solid company and they have great financials, this is a time to buy. So you can look at people who bought a lot of companies in 2008 and 2009. They built a tremendous amount of wealth during the Great Recession because they were buying strong companies when they were down. They removed their emotions, they made sure that they kept their emotions in check, and they understood one simple thing: be greedy when others are fearful, and fearful when others are greedy. Listen, I hope you guys gained a bunch of knowledge on these tips for new investors. If you have any questions, make sure you leave them down in the comments and I'll answer each and every one of those questions. And don't forget to like, subscribe, and hit that notification bell as well, and we will see you on the next video.